Hello everyone. Very good evening to all of you. Welcome you all in this session in the YouTube channel of Oliveboard. So I hope every one of you is fine. So what we have to start today is, as you all can see, we have to start today Module C Macmillan MCQs for your third paper, that is ABFM, Advanced Business and Financial Management. So we have started the series of Macmillan MCQs of both the paper ABM and ABFM because these two papers I'm taking. So in ABM, we have done module B, we have done module C, half of the part is done, okay, and module D. In ABFM, A is done, B is done. Today we will complete C as well. All right, so let's start the Macmillan MCQ series for your ABFM paper. Module C. So total in this session, we have 31 questions of your whatever the questions are included in your Macmillan book. I have added all the questions. So from the help of questions, we will be learning concepts. We will be revising all the important concepts. Okay, so practice of questions, not memory based, practice of revision of concepts with the help of practice of questions. So let's start this particular session. All right. So if you want to download your YouTube session PDF, so how you can download is that first you have to download Oliveboard application in your phone. After opening the Oliveboard application, you will see certain tabs over here. Click on the courses tab and you would be able to find all the YouTube class PDFs. So from see all, you can download the session PDF. So let's start with the first question now. So total we have 6 units in module C, that is all about corporate valuation and mergers and acquisition. So first question is here onwards. So what the question says that which one of the following does not appear on the profit and loss statement for a construction company that specializes in real estate? See, we know that in corporate evaluation, we have one topic chapter special cases of valuation. Now, in special cases of valuation, these are if you want to do the valuation of any special type of company, so how you will do that? And in that special type of company, one company is when you are doing the valuation of real estate companies. Now, so what the question says that when any construction company that specializes in real estate business, so which one of the following item does not appear on the profit and loss account, PL account? Which one of the following things are not included in PL account? So revenue from apartment sales, it is included. Interest that you have paid, okay, that is being repaid to the financials, it is also included. But cash that was put in the bank, because the cash that is already in the bank, so no need to mention in the profit and loss account. It will be mentioned in your balance sheet. All right, so option C is the correct answer. Now, question number 2. So second question says that it is expected of a valuer to conduct himself in a professional manner with objectivity at all times. See, because in the question only the answer is there. If you will read the question, one word is there, that is objectivity. What the question says that if suppose I am a valuer, okay, I want to value any company. I want to purchase a limited company. I want to do the valuation of this company. So how I will do the valuation? I should include everything that includes the objectivity of that company. Yes, I should not create any kind of biasness towards that company. So if a professional in a professional manner, I should be objective at all times by ensuring that his decisions are made without any kind of biasness. So without the existence of any kind of prejudice means what? That is biasness. So option A is the correct answer. Okay, with full assurance, yes, it's a responsibility that full assurance, a professional manner includes the assurance that 100% assurance the company should be valued. Okay, excessive influence of without any excessive influence, yes, because two parties are involved, then there is no need to involve any of the third party. So without the influence of that third party, the company should be valued. With the use of force means I'm a valuer. I want to purchase and you want to sell. So between us, the negotiation will be there, but no other party involvement is there. So without any kind of biasness in a professional manner, the decisions are taken. So option A is the correct answer. Now, question number third. Which of the following is not a place where records of sales of real estate in a certain area can be gathered? So in which where the record of sales of real estates are included, which is that place where it is not included. So if the record of sales data related to real estate business, it will be included. The sales data available would be available at a registrar's office in the newspaper advertisement as well. Information about the auction of the business from various authorities there will be included. But in equity market, it is not included at all. Option D. All right, so real estate sales records, these are related to property transactions. So real estate means what? The type of business which includes in the property, like the buying and selling of land, buying and selling of the you can say the property. Okay, not financial securities. So equity market is a market where financial securities are traded, stocks are traded, not real estate sales properties are traded. That is why it is not included in equity market. Now, question number 4. Which of the following valuation techniques is best for evaluating an owner-occupied, non-income producing residential bungalow? All right. Again, let's take the same example. Suppose I'm a valuer. Okay, I want to do the valuation of any company. So how I will do the valuation? What is the best method to evaluate if a owner-occupied bungalow is there? Means the owner has occupied that bungalow. The owner now that bungalow is not producing any kind of other source of income. Okay, non-income producing means not other source of income that bungalow is giving. And it's a residential bungalow, not a commercial bungalow. So how I will do the valuation? So in this case, I will find the similar type of bungalow. All right. If that similar type of bungalow is recently sold in the market, I will take the valuation of that bungalow. I will take the multiple of that bungalow. So it will be how it will be evaluated with direct sales comparison method, where the comparison of where one valuation of one property is measured, is valued as per the valuation of another property. We will take the multiples of another property. Suppose two properties are there. Let's take an example. I want to purchase A Limited, but the uh, A Limited does not have its all the details. Okay, no information is available of A Limited properly. So I will search similar type of companies who is doing the business just like A Limited. So I have found B Limited, C Limited, D Limited, E Limited. Now, whatever valuation of these companies are there, I will use the multipliers of these companies, and the multiplier will be used to find the actual valuation of company A. That is known as the comparison method. All right, so option B is the correct answer. And one request from you all, if you are new to this channel, then kindly subscribe to our YouTube channel. If you feel sessions are helpful to you, you are understanding from this session, then you can give a like to this session and share it with others so that more and more bankers they may get the benefit of attempting these questions and understanding the concepts. Next, which one of the following amount to direct cost is included in replacement cost? Now, direct cost is what? Like material cost that is directly used in the business. Okay. For your operating expenses, the cost that is incurring in the business, that is direct cost. It is included in replacement cost. Which one is that? Material expense, financial charges, legal cost, or license cost? So answer would be that is material expense, because material expense is what? That is the direct cost that are used directly in the business, like directly related to construction, or if any assets are being replaced. So if you're replacing any asset, whatever cost is used in that business, that is a direct cost. Now, so material expense are what? Like is the cement, steel, bricks. It's the core component of replacement cost. So if you're replacing any kind of asset, okay, in that everything will be all the cost will be all the cost will be calculated for that, and this will be called known as direct cost. All right. So whereas financial charges, these are indirect. Legal cost, the cost for litigations, for law, okay, extra cost that is indirect. License cost, this is also indirect. but material expense is the direct cost. Now next, question number 6. When making valuations, market-based approaches should not be used. See, this is now the question. It is from your chapter discounted cash flow valuation. So discounted cash flow valuation means if I want to do the valuation of any company considering discounting. Discounting means considering time value of money. Finding the present value of all future cash inflows. That is what the discounting is. So if when making valuations, market-based approach is not used. Now, what is market-based? Again, the comparison. So we will compare the similar type of property and we will use the multiplier. So in which one is not used in market-based approaches? When the size of the company is insufficient, when a company's assets are lower than their liabilities, in the event there are significant and unprecedented shifts in the marketplace. See, market-based approach are not used when there is flexibility in the market condition. Like every time the market conditions are changing, the market price of the assets are being changed. So in that case, it is not healthy to use the market-based approach because you have calculated according to the market base. Let's take an example, 50 crore. Okay, after 2 days, 3 days, 5 days, okay, the it because the market has changed. Now the value goes down to 48 crore or the values goes up to 55 crore. So it is changing very frequently. That is why market base is not used when there are unprecedented shift in the market price. All right. Okay, so a market-based approach is what it is a valuation method that uses market prices and metrics, or we can say multipliers, to determine a company's value, like PV ratio, PE ratio, all this. The discounted cash flow method of valuation is based. Now, discounted word is there. Then, so discounted cash flow method of valuation is based on a discount for the future that is anticipated and is likely to be earned. Company's valuation, anticipated cash flows along with discount rate. So in discounted cash flow, we will do the discounting. We do discounting with the help of cost of capital rate, the discounting rates, so that we can anticipate all the future cash flows and present value. That is what we do in discounting. The correct answer is option C. Next, question number 8. Under the discounted cash flow valuation, which of the following is typically employed as discounting factor? Now, what we use as discounting factor in discounted cash flow valuation? So again, right now I have repeated that the cost of capital, the discounting rate is given. So it is overall cost of capital. So discounting factor is what? That is cost of capital. So overall cost of capital is WACC. Now WACC is the discounting factor. Okay, it says that at least the minimum required rate of return that the shareholders they demand from your business. It's a discounting factor. It is used to convert all the future cash inflows into the present value. So money today is worth more than money in the future. So whatever money you are receiving, okay, you are earning now, that is more worth than the same money that you will earn in future. Why? Because of time value of money. Okay, let's take the scenario. Suppose you have got 100 rupees note. Now tell me, from this 100 rupees note, you are buying multiple things. Okay, after 10 years, will you able to buy the same amount, the same quantity with this 100 rupees? No, it will change. Why? Due to time value of money, the value of money will go down in future. So whatever money today is, it is worth more than the money in the future. So WACC is what? It is a minimum required rate of return that the investors are expecting from the business, both debt and equity. So correct answer is option D. Now, what does present value indicates? So present value is what? Value in use, the value of cash flows expected in future. So present value means the value which you are receiving in future. What is the value in today's term? What is the value in present term? That is present value. Now, question number 10. So question says the shares of company are quoted at rupees 40 per share. So shares are rupees 40. Last year, firm had paid dividend at rupees 4 per. Means this is the last year dividend. So we know that two dividend are given either DO or D1. DO is what? That is last year dividend. And D1 is what? Current year dividend or dividend yet to receive. Alright, yet to receive. Now, so we have to find D1. Okay, estimated growth of the company is 16%, rate of return is 20%. What is the market value of equity? Now, what we have to find, that is the market value of equity, means the price of the equity. So, price of the equity, what is the formula? D1 upon KE minus G. This is the formula. First, we have to calculate the D1 because DO is given in the question. How to calculate D1? If DO is given in the question, so D1 is equal to DO1 plus G. DO is given 4 rupees. 1 plus growth is how much? Growth is, see, growth is given 16%. Now, the 16% growth is given. So, can I write 0.16? Yes, 0.16. If I change 16%, all right, 4 into 1 plus 0.16 is 1.16. Now, 4 into 1.16, calculate, let me calculate. 4 into 1.16, so 4.64. Now, okay, dividend is what? That is 4.64. K is what? Required rate of return, that is 20%, so 0.20 minus 0.16, 4.60, 4.64 upon 0.04 equals to divided by 0.04. It is, what is the market value of the stock? Rupees 160. So option C is the correct answer. Understood? Any doubt in this question? So cost of one share is 160. All right, so this is the formula. All the answers are given to you. Next. Next question starts from other non-DCF valuation models. Means now if we are doing the valuation of any company without considering discounting, without considering time value of money. So relative valuation approach is also known as relative valuation approach is known as again the market approach. We find the relative, means the related value we use to take for doing the valuation of a company. So it is a market approach. Okay, comparison approach. So it is none of the above. No income approach, no asset approach, no liability approach. So option D. Now 12. Question number 12. The worth of an asset can, okay, this is can be determined by analyzing its pricing in relation to the comparable assets. And this price can be measured as compared assets in terms of earnings, cash flow, book value, or sale. Now, what is that known as? Again, we are finding the comparable assets. Okay, the comparable assets, the value of those comparable assets are used to find the actual value of the company which I want to purchase, which the valuer wants to do the valuation. So it is used in relative valuation. So you can see that how much questions are from the comparable approach, market approach, and relative approach. Question number 30. A ratio that illustrates the stock market's readiness to pay for 1 rupee of earning per share is referred to as an earnings multiple. Means what is the earning the company is making from its 1 rupee? That is referred to as an earnings multiple. So that is ratio of price to earnings. Price to earnings. Option number option that is C, PE ratio. So we say PE, okay, PE multiple or PE ratio. So PE ratio is what? That is market price per share upon earnings per share. MPS upon EPS. Option C. Now, price to earnings ratio goes up when any one of the following conditions are met. Now, which one of the following conditions are met when price to earning ratio goes up? So, price to earning ratio goes up when growth goes up. Okay, discount rate goes down and reinvestment rate stays the same. Now, growth goes down, discount rate goes down, and reinvestment rate goes up. Growth exceeds expectation, but discount rate and reinvestment rate fall short of so price to earning ratio is what? That is market price per share upon EPS, that is moving high. So means how much, okay, the value of the shares in the market as compared to the earnings that the company is making, that is going high. So in this case, now when growth is going up, discount rate is going down and reinvestment rate is same. See, growth will not goes down because the market price is going high. So market price of the share is going high. The value of the shares in the market price is high means the growth is high. So growth is on, it is wrong. Growth exceeds expectation, but discount rate and falls short expectation. No, when growth is exceeding expectation, so discount rate would be less. This is also wrong. Discount rate goes down and reinvestment rate goes up. But in this scenario, growth goes up, discount rate goes down, and reinvestment rate stays the same. So option A is the correct answer. All right. Now next, question number 15. Which of the following is not factored into the WACC calculation? Which of the following is not included in WACC calculation? That is weighted average cost of capital. So weighted average cost of capital, what is its formula? So in weighted average cost of capital, we include the cost of debt also. Yes, right. Cost of preference shares also. Cost of equity also. Now every cost, their weights are also assigned. So we can say cost of debt into weight of debt plus cost of equity into weight of equity plus cost of preference shares into weight of preference shares. All right. But in this, weight or proportion of debt are included, equity proportion of weights are included, cost of equity capital is included, but individual tax rate on interest income is not included in WACC. So this is weight of equity, cost of equity, 1 minus tax rate. This is the tax rate of the company, not individual tax rate. So that is not included. All right. Okay, done. Now question number 60. Special cases of valuation. What are intangible assets? So what are intangible assets? Non-monetary assets with tangible value, financial assets devoid of physical substance, non-monetary assets devoid of physical substance, or monetary assets having material form. So intangible assets are those assets which we cannot see them, we cannot touch them. So these are non-monetary assets that are devoid of physical substance. So option C is the correct answer. Now, question number 17. Which of the following approaches do you believe is most suitable for the purpose of determining the value of intangible assets? Which of the following approaches is most suitable for valuing intangible assets? Multiple evaluation model, relative, consistent, or exclusive? Because intangible business, now this is again intangible sort of business, comes under special cases of valuation. All right, so special cases of valuation, if I want to do the value of any kind of intangible business that includes intangible assets, so I will find the comparable type of assets. So that will be used in relative valuation, multiple not. So option B. All right. Now next, which of the following statements is correct? So financial companies by their nature are not highly levered institution. Okay, you only tell me financial companies, they take the help of loan. Okay, consortium loans are provided, loan syndication are given to borrower. Now, how these financial companies they arrange loan? Okay, the deposits are there. They take loans from big banks, from RBI. So that they are not highly levered institution. No, they are highly levered institution. Net interest income and fee income are the least important source. Income, fee income, these are the important source of income for a bank. So whatever income the bank will receive, it will receive from the interest, okay, the loan interest and other kind of loans that are offered to the borrower. The interest is the crucial. This is the interest is only the profit of the bank, income for the bank. So this is also correct. These are not a least important. These are much more important source of income. A basic principle of accounting says that capital expenses should be separated from operating expenses. Yes, capital expenses are for a long term, okay, long period of time, and operating expenses are for your daily activities. So these two types of expenses are to be kept separate. Yes, this is the correct answer. So ultimate beneficiary of technological change is always the firm, not the consumer. No, because of consumer also many things changes, like the taste and preference of consumer changes. So entire business model changes. So that is not only because of technology, the firm changes, but also with the consumer, the firm also changes. Now, which of the following would have a negative impact on the demand for real estate? Negative in demand. What is the negative demand? Negative impact. If low liquidity is there, that is a negative impact. Means liquidity means the company is not in a position to pay their short-term obligations. So company is not in a position to pay short-term obligations. That is a negative impact on the demand. So option A. Now, what is convertible security? So convertible, see there are two terms. One is convertible and non-convertible. Convertible means that can be converted into common shares of the company later on. That is the convertible. So it could be convertible debt, convertible bond, anything, convertible loan that can be converted into equity later on. Non-convertible means which does not have the option to get converted into common shares of the company. Common shares of the company means what? When I say common shares of the company means what? That is the equity share. So convertible security is what? Convertible into cash? No. A bond or preference shares convertible at the company's option? into an equity? No, not at the company's option. This entirely depends upon the holder of that convertible security. Like I'm having convertible bond, so I have the option that I can convert my bond into common shares of the company. So bond or preference shares that can be converted into equity shares at the choice of the holder. So option C is the correct answer. All right. So all the answers are given to you. I have to check. Let me check one question. Yes, this is correct. All right. So the price to earning ratio goes up when any one of the following conditions are met. See, in this uh, growth goes up. Okay, when price to earning goes up, discount rate goes down, but reinvestment rate stays the same. See, till here it is correct, but reinvestment rate does not stays the same. It will also increase because if you are earning more, if your earnings are more, then definitely you will going to reinvest that particular earnings. So this is not correct. Okay, let me correct the answer. So option D is correct because here it says growth goes down. This is not correct. Here it says growth goes up. It is correct. This one is correct, but this one is not correct. Growth exceeds expectation. This one is correct. But discount rate falls. This is correct. But reinvestment rate also falls. This is not correct. Here, discount rate goes down. Yes, when price to earning ratio goes up. But reinvestment rate also goes up. So option D is the correct one. All right. Okay. Now, so before moving further, if you have, if you want to make your preparation more better for your upcoming examination, that is May, June 2026, and if you have not yet enrolled in our paid classes and if you are thinking to enroll, then CIB Super Elite Plan is best for you. In this plan, you will get a lot of benefits. That is 2000 plus live classes are there. First, we will provide you the foundation classes. In foundation classes, we will do everything in detail from scratch. Okay, all the points, all the topics, all the units are covered in foundation batch. After completion of foundation batch, then crash batch is provided. So in crash batch, we will do the revision of all the topics. So we have started with our crash batch. Okay, we have done one module also. One module is yet to complete in crash batch. After this, the cracker batch is provided to you. In cracker batch, we will do MCQs, okay, questions, and one last batch access will be given to you, that is capsule, 1 week before your class. So if you want to avail all the benefits, you can purchase our Super Elite all in one plan. 200 plus tests will be given. Special sessions will be conducted where we will discuss questions according to previous year pattern questions. Summarized notes are there. Case study, numerical elective paper tests are there. Doubt clearing sessions are there. And a special community tab is given where you can tag your educator if you want to ask any questions from them. And one more thing that is given, if you have enrolled in our paid classes and if you have watched any session, after watching the session, if you want to do the revision of that session, so within 10 to 15 minutes, you can revise the entire session with our 360-degree study kit. Now, what are the elements that are included in this 360-degree study kit? First is the quick summary will be provided to you. Detailed notes will be given to you. Frequent asked questions are there. Revision flashcards are there. PDFs are there. And time frames are also there. So with this, you can get more benefit of revising the session. Now, next questions, it will start from question number 21, mergers, acquisition, and restructuring. Which of the following statement is correct? In a reverse merger, a small company acquires still smaller company. Now, see, in each of the statements, it is talking about a reverse merger. What is reverse merger? Reverse merger is a merger where a smaller company, or we can say unlisted company acquires a larger company. This is what a reverse merger. So see, in normal merger, what happens? Big company acquires a small company. This is what It happens in normal merger. Now, if it's a reverse merger, so what happens? A smaller company or unlisted company acquires a larger company or listed company. So in this, what would be the correct answer? That is, a smaller company acquires a larger company, option B. So small private company acquires large private company and becomes a new private company. Okay, new public company. Why? Because this is what? This is a listed company, a public company. So small private company is acquiring a large public company and becoming a new public company. Now, a merger is said to be synergistic if the combined value of the companies is greater than. So synergistic is what? When I say value of company A and B will always be greater than value of company A alone plus value of company B alone. Or we can say company A and B will always be greater than value of company A alone, value of company B alone. So if suppose the value of company A is 200 crore, value of company B is 200 crore. If both these companies are combined together, if it would be more than 400, like let's take it 500 crore, then this is known as synergy. So synergy is what? When the aggregate value means the total value of the individual companies is always greater than. Means the combined value of the companies is always greater than the aggregate value of the individual companies. So combined value of the companies is always greater than the aggregate values of the company. Option A is the correct answer. Now next, question number 23. Which of the following entails dividing a large corporation like conglomerate, which is comprised of various divisions into multiple independent businesses? So if a company is splitting into different multiple independent business, what is that term called? Suppose a big company is there. Now this big company is splitting into small companies. Okay, this company, let's take it, this company A, one company is there, then company B is there, this company C, okay, this company D. So big company splitting, dividing its units in multiple independent business, that is known as demerger. Okay, merger means combining together, demerger means that is splitting to different units. Now, so what is stock split? Now, stock split means when the stocks are splitting into different value of shares. Like if I say one value of share is rupees 200. Okay, one share cost rupees 200. Now, if I'm splitting this share, so can I say that two shares are there? Two shares are costing rupees 200. It means one share is value rupees 100. Means each share is valuing rupees 100. The number of shares are here, the number of shares becomes multiple, but the value remains same. So shares are divided into smaller parts. So one share becomes multiple shares, but value stays same. Amalgamation means when two companies are coming together. Okay, combining together into one. Like company A and company B. These two companies combined together and they formed entirely a new company, that is company C, for growth purpose, for expanding their business, for synergy. Share buyback means company is buying their own share. Why? So that company can increase their market value. Okay, company can get the cash in return if company is in need of return. That is why company is buying back their own shares. Now, demerger means one company split into two or more multiple independent companies. Why? Why this happened? Suppose this is the big company. Now, company cannot pay attention on its entire department on all the units. That is why company has split down separate unit. Now, the separate unit will have their own shareholders, will have their own managers, will have their own clients, so that they can pay attention to this single specific department or unit. That is why is demerger takes place when a company does not pay attention on all of the operations on all of the departments. So companies split to different units so that specific unit can be given more importance. They can manage their business well. Now, what kind of merger takes place when two companies whose business are unrelated? Suppose company A, okay, and company B is there. Now, what kind of merger takes place when two companies whose lines of business are unrelated means they are not related to each other? Like company A is dealing in shoemaking company, okay, and company B is making the processed food items. If these two companies are merging together, now what does that particular name called? Horizontal. Horizontal integration is when the company are merging in the same business, in the related business. Amalgamation is when two companies they combine and they form a new entity. And vertical integration is for market extension. Okay, vertical integration is there for the expansion of the supplier and manufacturing relation. That is what the vertical integration is. Now, when two unrelated companies are combining together, it is known as conglomerate. Clear? Next, question number 25. Which of the following is not an example of a measure that a target company might take to avoid being acquired? See, we know that the company who wants to acquire another company becomes the acquirer, and the company who is acquiring another company, that company becomes what target company. So sometimes it happens that target company does not want to get acquired. Okay, target company does not want to get acquired in the acquiring company, but still the acquirer company wants to acquire the target company. Like A limited company wants to buy B limited company, and B limited company does not want to get acquired in A limited. So what in that case, what would B limited do? Such type of acquisition is known as hostile acquisition. One is friendly acquisition. Now, in friendly acquisition, what happens? Both the companies, okay, they are ready. One is ready to buy and another one is ready to sell. That is known as friendly acquisition. In hostile acquisition, one is ready to buy, but the selling company, the seller, the target company does not want to sell its company. That is known as hostile. So in such case, there are some defensive mechanism. Okay, defensive strategies are there for B Limited so that B Limited can protect its company from A Limited to get acquired. Now, so in this is not an example of the measure that a target company might take to avoid being acquired. Which one is not an example of the target company? The option that the target company gets to avoid being acquired. Poison put is option, golden parachute is there, staggered board is there. But poison call is not any kind of option. So poison pill is there and poison put is there. But poison call is not any kind of defensive strategies. So anti-takeover defense is what? So companies they use various strategies to prevent hostile takeover. And these strategies are divided into two main types. One is before the offer has been given by the acquired company, and then you can use defensive strategies. And when the offer has been given by the acquiring company, after an offer is made, then you can use strategies, and before an offer is made, then. So in that case, we have staggered board. Staggered board is what here the board of directors. See, if a company is having one director, okay, and if that particular director is same, then it becomes easy to get acquired. But in every year, okay, every year the directors are changing, so it creates confusion in the mind of the acquiring company. So acquiring company will always be in a dilemma that to whom I can do the deal because the board of directors are always changing in the company. So it becomes harder for an acquirer to replace the entire board at once. So it is divided into three groups and with one group that is elected every year. Supermajority clause is what? Here, if the majority of the company says that yes, we are ready to sell our company, then only it is possible to be acquired. Otherwise, the acquiring company cannot acquire the target company if the majority is not. Poison pill is what? When shareholders they are given the right that they can buy their shares at discount. See, if any shareholder will get the option to buy the shares at discount, so definitely that shareholder will buy more shares. Why? Because the value is at the discounted price, and which makes the company more expensive because shareholders are having more shares, so their value will always be high in the company. So it will make more valuable in the eyes of the acquirer. That is what poison pill is. So here shareholders are given to buy the shares at a discounted price. Now, poison put is what? In this, what happens? The target company issues new shares, new bonds, and the target company redeems that shares and bonds early. So that if the target company is buying back their shares, so again, there are no shares left in the shareholders, so which makes the target company very less attractive in the eyes of the acquirer. And with this, the acquirer will not going to purchase the target. All right. Dual class shares are what? When the same shares are given, are reissued with a better voting right. Like any shareholder was given a less voting right. Now, if the second time those shares are issued, so it will give the shareholders more control and more right. So in this way also, the target company can save their company from getting acquired. All right. So what was the option? Poison call is not any kind of option given, defensive strategy given to the target company. Next, question number 26. Which of the following terms best depicts the situation in which both parties they are attempting to find a resolution to a complicated disagreement? If there are disagreements are happening and both the companies they want to find a midway solution, then what is that midway solution? It is only possible, yes, it is only possible when both of the companies they get 50-50. That is, some both the companies they win in their way, means they find midway solution, that is 50-50 negotiation is there, then only it is possible, then only it is acceptable to both of them. Mutual benefit is what? That is okay, one will get the benefit. Okay, mutual benefit means both are accepting that particular fact. That is, both are mutually they are coming to a conclusion. Win lose means if one is getting 100% and another one is getting 0%. Zero sum means both the companies are getting 0-0. And win-win means that both the companies they have got 100%, 100%. Both the companies have fulfilled what they want. Means both of them have agreed on the midway solution. That is both of them win-win. Then only that disagreement is accepted. All right. Next, which of the following is not considered to be an intangible aspect when it comes to the negotiation purpose? Intangible aspect. See, when negotiation happens, negotiation will only take place when, if I'm asking that, okay, I'm saying something else, you are saying something else, okay, we are not coming to a midway solution, then we are trying to find a negotiation, we are trying to find a midway solution for that. So this is only possible in the case of the final prices. Negotiation is done when we have decided the final price. The final price is, let's take an example, 50 crore. Okay, I want to purchase the company at 50 crore. This is this is the value at what this is the value at which I want to purchase your company. And you are saying that no, I'm ready to sell at 80 crore. See, obviously the purchaser will always want to pay less for the company and seller will always want to sell at a more price. So in this case, how negotiation will take place? Well, the negotiation will only take place at the final price that is agreed in that contract. So importance of preserving healthy relationship, no, negotiation is not done for that. Negotiation is done at the final price that has been agreed upon a contract. Because ultimately, if that contract is fulfilled, If the contractual agreement is done, then only the final price, then only the negotiation will take place on that final price. So option B is the correct answer. Clear? Okay. All right. So option B, not considered to be intangible. That is option B. Now, next is question number 28. When it comes to reaching an agreement on the condition of the merger, two of the most essential topics are post-merger control. Now, post-merger control happens when? Means when the merging takes place and in that merging, the companies merged together. Now, it has to be decided that who will become the new shareholders of the company, who will have how much ownership in the new company, in the new merged company, new entity. Then that is decided. So it is decided what? At the negotiated price, computed price, market price, or price per share. So in post-merger control, because two companies, company A and B, they have merged together. And if they have merged together, so either A's existence will be there or B's existence will be there. So they have to come, okay, they have to agree on what the condition on the negotiated price. That is the price at the value at which they have, both the parties have negotiated for. So option A is the correct answer. Next, question number 29. What the question saying again, mergers and acquisition. It is increasingly common for mergers and acquisition transactions to contemplate deferred contingent payment to sellers. In what part? As a part of consideration, as a part of the deciding the actual price when the buyer and seller they cannot agree on the actual cost or the actual value of a target company. When buyers and sellers they cannot come to a conclusion that at what price the buyer is ready to purchase and at what price the seller is ready to sell. So this type of payment which is contingent upon the happening of certain event. Now contingent means what? Contingent it occurs that if this will occur in future, like we have studied all about contingent plans. Contingent plan means what? That in case of emergency, in case of any other situation arises, we have another plan, we have plan B. So contingent only takes place when any certainty or uncertainty is there. Certainty of happening of any event is there, or uncertainty of happening of any event is there, such as meeting a post-transaction earning goals, and that is what it is known as. See, basically this question is describing a situation in mergers and acquisition. We know that buyer and seller they cannot agree on the company's value, so they decide that pay some amount now and rest of the amount pay after some time, means pay extra only if certain targets are achieved. So conditional payment is there, like if you have achieved 10% profit, 20% profit, or if you have make some earnings in the company, if you have made some earnings, then pay extra. Now, the payment contingent upon achieving targets is what? So that payment is what? It is conditional. It depends on the future performance, that is contingent. So what do we call this type of payment agreement when it is based on the contingent actions, that is the happening of any event, happening or non-happening of any event. So first option says that contingent liability. So this is about possible future obligations, not payment to sellers. So it is not correct. Then deferred payment agreement is what? Deferred payment agreement means just means the payment is delayed, but it is not necessarily that it is conditional. Contingent asset is what? It refers to uncertain future assets, and this is not a deal structure. But earn-outs are what? Earn-outs, these matches with the question. It means the payment made later and it is based on the performance target. So once a certain level of target has been achieved, then the amount will be paid. So that is what? That is the earn-out. So the question, according to this question, what would be the correct answer? That is the earn-outs. Understood this question? Clear? Now, Question number 30. A taxpayer in India may generally carry forward business losses for a period of up to how many assessment years in which the loss was first computed? See, okay. In special cases of valuation, we have studied one topic that is known as the loss-bearing companies. Loss-bearing companies or distressed nature companies. Okay, can anyone tell me that why any valuer or any acquiring company wants to purchase a company that is loss-bearing company or distressed nature company? Suppose Limited company is there. B Limited company is a loss-bearing company. This company is making loss from the past 3 years, 4 years. And A Limited company is there. A Limited wants to purchase B Limited. So why would A Limited is willing to purchase B Limited even if it is clear that B Limited is making continuously losses from the past 3 years? Let's take it past 3 years. See, what fact is that if because see we know that taxes are what? Taxes are progressive in nature. Taxes are progressive in nature. Progressive means as your income increases, you have to pay taxes more. If your income is less, you have to pay less taxes. If your income is more, you have to pay more taxes. So if a company is making more income, company will have to pay more taxes. All right. Suppose A Limited has made a profit of, let's take an example, 50 crore. And B Limited has made a loss of 10 crore, minus 10 crore. So if company has earned 50 crore, the income is 50 crore. Now this A Limited has to pay taxes on 50 crore. The government says because your income is 50 crore, so you have to pay taxes on 50 crore. What if A Limited purchases B Limited? So now this B Limited, the loss of this B Limited will also come under A Limited. So 50 crore plus minus 10 crore. Now what is the actual amount left that is to be paid to the government in terms of tax? Now A Limited will have to pay on 40 crore the taxes. So that is why major companies they purchase those companies which are loss bearing companies or distressed nature of companies so that they can save the taxes. The tax liability would be less. So where the company has to pay taxes on 50 crore, now A Limited will have to pay the taxes on 40 crore. So the benefit of 10 crore is given to it. Now, this type of losses, it can be set off. Okay, it can be carried forward for how many years? 2 years, 5 years, 8 years, 10 years. This loss can be carried forward for how many years? It can be carried forward for 2, 5, 8 or 10. So it can be carried forward for up to 8 years. So up to 8 years, the company can carry forward the losses. After that, if company have settled in the 8 years, fine. If company has not settled in the 8 years, then in the ninth year, company cannot forward that losses. Okay, so maximum time period is that is 8 years. All right, so option C is the correct answer. Understood this question? And with this, we have done our Macmillan MCQs. So Macmillan Module C MCQs. 30 questions were there in your Macmillan. So I hope all the questions are clear to you. You have understood each and every question what we have discussed so far. If yes, then do like the video and share it with others. This is our Telegram channel. If you have not yet joined this Telegram channel, kindly join by scanning this QR code. You will get regular quizzes and polls. All the updates of the YouTube class will be provided there and important notification will also be provided. So right now, it's a flat 50% off is running on all the JIB and CIB subscription plans. So what code you can use to avail this benefit of flat 58% off? That is FEST. And it is ending today, tonight it will end. So before that, you can grab this opportunity and you can enroll in our paid classes. So moreover, if you feel sessions are beneficial to you, like the session, share it with others and subscribe Oliveboard JIB CIB English medium channel. And if you have any doubt, you can comment it. Okay. So PDF is uploaded. Later on, you all can download and go through the PDFs. Okay. And let's meet in another session. So we will discuss some of the more questions related to Module D in AB. All right. Okay. Sure. So let's meet in another session. Till then, take care, everyone. Goodbye.